All right, so welcome into another podcast. I'm Tim Michaelides. We've got Mike Hornops here.
Morning.
So basically today we're going to talk a bit about interest rates, which is quite fitting considering the RBA has just lifted rates for the first time since 2010. So we're going to go through the ramifications of that, what it means for the housing market, what it means for the stock market and the general economy. So, Mike, you've got some slides there you want to talk to?
Yeah, I've got some slides here that set up the scene for where we are on interest rates currently and where the interest rates are projected to go according to the futures market, which is obviously a highly liquid market. So it is where the market thinks interest rates are going. You can see the slide there at the moment that we had the 0.25% interest rate increase last night. But if you look at that blue line on the first slide, which is the Australian 90-day bank bill futures, you can see that the market's predicting a very quick and steady rise to that 4% level. So 0.35 going up to 4%. Now, we'll be talking a lot more about the implications of that. And as a contrast, I thought I'd put up the US interest rates as well. They're what they call the futures curve, the 90-day futures curve. So, and just to say, what does a futures curve means? It says, well, not what is the 2-year bond rate today, but what is the 90-day bank bill rate, what the banks borrow at, what's the 90-day rate in June next year. So you can see the US curve, yield curve is not as high as Australia, and so that is interesting in itself, as the RBA has been very slow to lift interest rates and the US has been a little bit quicker. And I think today from the US we're expecting a 0.5% increase seems to be the consensus in the commentary, maybe 0.75, and won't that scare people if it's 0.75%. So the market now expects interest rates to go up. We really have to think about what ramifications that has for us as individuals, us as investors, and us as family people trying to manage our finances. I'll move over to the next slide, and Tim and I were talking about interest rates, and Tim made a very interesting comment that in his generation, 40 years or less, you have not seen a sustained rise in interest rates. So the chart we have up here is the home loan mortgage rate as provided by the Australian Bureau of Statistics and the RBA. The home loan interest rate, the average home loan variable rate since 1990. And you can see that over a 32-year period, the interest rates pretty much have gone down. Now, and by just being in the market the last 30 years, the house prices have gone up, haven't they? And they've gone up because of what you're looking in front of you. A couple of interesting points you can make there. You can see in 2008, notice the RBA lifted our interest rates up to about 7.25% there from memory. And what was interesting is that the RBA didn't drop interest rates. Like they're not increasing interest rates today, we say they're behind the curve. Interestingly, in August 2008, interest rates were still 7.25%. And of course, the RBA, or the Reserve Bank of Property, they quickly just dropped those interest rates down to 2009. But you can see that trend. So what's happening is a 22-year bull market in interest rates, funding the ever-increasing home loans out there, funding the ever-increasing capital gains out there. And then that last orange bit at the end is the projected interest rate increases, as I just showed on that futures curve. So you can see this projection is a massive sea change in interest rates, and I think the interesting comment that really touched me was when Tim said our generation has no knowledge of this.
No, not at all.
And ask your friends, ask your families, how do you make money in this market? Well, you buy property and you hold it. Because anybody under my age has probably, and I'm in the 60s, anybody at my age has not got a memory for when things were bad as interest rates went to 18% in the 80s, in the 1980s. So this is a different dynamic. You talk to millenniums, it's, well, I've got to get in the housing market, and hasn't the bloody government supported that notion with shared equity and grants and all that. So the point being, interest rates have come down a lot over 20 years, and properties prices have gone up, and people borrow more money. So I'm just going to move on to that third slide. I just quickly talk to that. Now, so I'm trying to demonstrate the dramatic nature of what's going to happen with how interest rates increase. So let's start off with that blue line, and that's the amount of outstanding home loan debt as published by the RBA every month since 1990. And it's gone from a paltry $55 billion in 1990, and it's just chugged all the way up to that. As of last month, it's chugged up to about 2.1 trillion. So it's gone from 55 billion to 2,100 billion in that time. And I wanted to demonstrate that increasing debt was able to be absorbed by the average home loan investor, the average mum and dad could absorb it. So what I did with the red line, which relates to the right-hand scale, is I took that mortgage interest I had on the previous slide, and I took the mortgage interest rate and multiplied it by the outstanding home loan debt. So basically, what payment is the whole economy paying for the outstanding debt? Just a simple metric. And what you see is that as the home loan amount of loans are outstanding especially through the 2010s, that red line really went sideways, and then from 2018 down to March, down to currently, rates went down. So the interest payment went down as the home loan debt is increasing by about 8% a year. And that's the affordability factor. So we didn't need higher wages. We didn't need greater productivity. We just needed interest rates to go down to support this massively increasing debt. Now, what we're trying to demonstrate in that last peak up, I probably should have done that as a different colour just to make it obvious, but that spike of the debt servicing is an increasing cost of servicing the total debt. It's not a perfect metric. It's trying to make an example of what it means. So as of before the interest rates increases, as of day before yesterday, the monthly payments on 2.1 trillion debt was about 55 billion per year. That 55 billion is going to grow to 129 billion. 59 billion to 129 billion by the middle of next year, if the forecast for interest rates increases are accurate, if that's what the government does. And I think Tim's going to talk about, well, what the market's saying today, can it actually happen? That's going to be interesting.
That's a big part of the conversation at the moment, isn't it?
It is a big part of the conversation. Yeah.
So that's just looking at that chart there, though. That's a lot of money coming out of the back pockets of everyday Australians paying their home loans, right? That's a lot of money coming out of that space, isn't it?
No, absolutely right. And 55 to 129. Well, that's 150% increase.
It's huge.
That's
150.
Huge.
That's triple. That's triple.
Nearly
just
triple.
Really
nearly triple.
Perspective. It's tripling the amount that someone will have to pay to cover their home loan.
That's right. So, and I think you're going to tell us, people also are looking at the inflation out there, whether it's demand inflation or it's supply side inflation. there is inflation out there, isn't there, Tim?
Oh, absolutely. And I don't think we've seen the worst of it yet, have we? Right? When you hear the stories of what's happening overseas, especially in the food side inflation, we have not seen that yet in Australia. Yes, we're seeing food prices go up, but nowhere near as much as what the US and the UK are seeing at the moment.
Yeah, it's interesting. I was talking to one of our clients who runs about 10,000 head of cattle in central New South Wales yesterday. I think I might have mentioned it to you.
Yeah.
And in the downturn, he was getting about $2 a kilo per kilo for steer, and that $2 has increased to $11.
Yeah.
Right. And then you got to throw on the multipliers before it gets to our dinner plate.
Yeah, that's it.
But the general point I was making is that those mortgage payments are going to go up 150%,
Yep.
and food prices are going to go up.
Yep,
That's the issue.
And then the big question long term is energy, right? So we know we haven't seen the energy increase that much yet because the government halved their excise on petrol, but that's only got to use by 6 months, wasn't it? So
Correct.
what happens after 6 months there too? So
Well,
there's a lot to think about here and unpack.
And that possibly might have been an election stunt. Well, obviously it was an election stunt. And see, the Americans have had a feel for an increase in interest rates of their 0.25%, and New Zealand cash rates are up to 1.5%. But we haven't felt the interest rate increase up until yesterday, and the banks, I don't think, have started to lift yet, but they will.
No, they did. They announced straight away. So CBA was straight off the bat last night. As soon as I turned the news on at 6 o'clock, CBA was the first to go. And the big four now have all passed on that rate hike.
And the point is, you don't really believe it until it affects you.
Yeah,
That's the
it.
point.
That's it.
And if our interest rates were 1.5% higher and people were paying 1.5% more, they'd have a different attitude than, geez, I hope it's going to be okay attitude.
Yeah. So let's get into some of the detail on this and what it actually means for the individual, right? Because it still set the perspective for a lot of people out there. And I think a lot of younger people that maybe first home buyers have just come into this market don't know what's coming for them. Right, so just to go back to some of the slides that were up before, Mike was talking about the futures market. That's the bond market. That's where people believe, so bond traders, analysts out there believe interest rates are going in the future. Okay, so that's an indicator for us. We look at that very, very closely every single day for indications. So last night's raise in interest rates, 0.25%. If you've got a loan of $700,000, and the reason why I've picked $700,000, by the way, is the Liberals' home guarantee scheme caps out at $700,000 in Melbourne. Okay. Most townhouses these days, you'd be lucky to find a 3-bedroom townhouse that's going to be around $700,000. So I'm basing it on that type of home loan because, let's face it, if you're a first home buyer, you're starting a small family, that's about what you're spending right now, okay? If not, you need a little bit more, right? But I'm not going to go there. So what's that mean for you? At the moment, well, it means an extra $1,116 per year. Okay, 0.25% rise. It's not that bad. Okay, so right now we're okay. But Philip Lowe did indicate in his speech that rates are going to continue to go up this year. We've got a bond market that's indicating that rates could go up another 2% from here. Right, so let's break that down for a second. So if I base a loan at 2.7%, which was the variable rate only last week, or a couple of days ago, that means that on that level you're paying $2,840 per month to service your loan. A 1% increase, okay, from that base means you're going to be paying an additional $4,580 a year.
Wow!
How is a small family on maybe a wage around $120,000 net going to afford that?
But I think the point is that we all spend, the average person spends most of their income already keeping up with childcare, food costs, housing costs, and then somebody's going to say, find another $4,500. So it's at the margin is going to cause some issues.
Correct. Now that's based on 1%, right? And that's kind of where I think the RBA is going to go, right? That's my personal view. I think they'll probably cap out at a 1% increase. But what if the RBA raises by the amount the bond market's suggesting?
Well, I think, and Tim and I talk, and we talk in the office a lot about this. And if interest rates, according to that futures curve I put out, and it's a 3.8% is what the futures market is saying. Well, that's 3.5% away. So 3 times of the increase you just mentioned. I think and also the commentators in the US, I think we're all in agreement. If it goes there, we're all buggered. Let's just say that. And so therefore we're saying we think that the market will probably lift, 1.5%, but then they'll go, oh Jesus, the housing market auction rates will go down to 20-30%.
Yep.
These home loan stressed mortgages in the west of Perth and in the west of Melbourne, those numbers will start coming up, and there'll be a lot more social security payments, and there'll be a lot of bad debts, which is a thing for the banks. Absolutely. And they'll have a good look at that and go, hang about, let's change their mind.
Yeah.
That's what we're saying, I think.
Yeah, absolutely. Yeah. I think so as well. I don't think they'll let it get that far this time around. The dynamic's very different to what it was even 10 years ago, right? So, I got into the housing market personally in 2013. Most 3-bedroom homes were worth about $500 to $650,
yep.
Right? It was in that price range. Interest rates were about 4.5% back then, which meant my loan repayments were about the same as what they would be now at the current interest rates on a house that's worth $700, right? So can rates go back to 4%? I can't see it happening, guys, not with house prices up here. Not unless we see huge wage growth, which I don't think is happening either.
And then you got to bring it back to your investment philosophy. So what we're talking about is look, this is what they're saying today. This is the expectation. Now, you need to allow for that to happen, but then the risk is that they change their mind, and what are the implications for that? Yep. It's how you manage your portfolio.
Yeah, that's right. So I guess that's a big thing for the stock market as well, right? So what actually happens to the stock market at the point of which the bond market starts pricing a lower interest rate again? And I'm going way out into the future now, aren't I, right? Like, this is not going to happen overnight. It's not going to happen probably even for the next 6 months, right? But longer term, next 12 months, what happens to the stock market if the bond market yields top out and start falling again, which means buying in the bond market happens?
And I'll just make a point on the bond market, which I do follow closely. I recall in around 2018-19, our 30-year bond, the one that matured in 2050, albeit that it was trading at a yield of 3.85%, right? And subsequently that's gone down into low 1% figures. But at 3.8%, the purchase price of that bond that was issued for $100, the purchase price was $85. So I could have bought that bond at $85, which is I get the 15% capital plus I get the 4% odd coupon. Now that as the interest rates went down, and we were saying in the office we should buy that and just set and forget. That $85 bond went to $140 as interest rates fell. That was the power of falling interest rates.
Yep.
And the point I would want to take that those long-term bond rates are getting up there. I think the Australian 10-year bond's about 3.3 at the moment. Now, if they get back up to 4%, and then you have a feeling in whatever your own personal position is, if you have a feeling that the bond market might rally again because the government has to pump prime, you've got an asset that can go from 85. You can buy that asset for $85 and look for good capital gain in the bond market. Yep. When was the last time you could say that? Well, that was a few years ago. But yeah. So that's the issue.
It's getting back to that point soon, isn't it? Right.
Yeah.
So one of the things that we're talking about doing for our members is Mike's going to run a video once a week for our members to talk about things like this and identify opportunity when it arises in the bond markets and the stock market, and talk in a bit more detail around this sort of stuff of money flowing, right? So, recently what we've been seeing is a lot of money flow out of the bond market. People are selling out of bonds, coming into different areas, equities, housing, whatever, as an investment. But what we're talking about here is at what point does that money flow back in, right? Where do people see value in bonds and want to buy bonds again, which will take some money out of certain areas of the equity market, and jump back into that space.
So we'll be looking for the economic indicators that's saying, listen, the housing market's slowing down. Bad debts with the banks are increasing. And there's flow-on effects to the jobs data.
Yep.
If our government does bring in another 200,000 people and the economy slows down, you'll be assessing those issues to see whether the government has to reverse the quantitative tightening back to quantitative easing,
yep,
and to stop increasing interest rates with a bias towards lower rates again.
yep.
And that'll be an indication of looking what implications those have for individual stocks, value, growth,
Yep.
utilities, REITs. That sector allocation is what you want to be analysing as we go
Correct.
through these next 12 months.
Correct. Because the current theme at the moment really is value, isn't it, right? So interest rates are going up, money flows towards value stocks and flows away from your typical growth stock. I'm sure many of you guys have looked at a chart of the Nasdaq recently, sitting at yearly lows, threatening to break through some key support levels. And, so you definitely get a run out of growth at the moment, don't you?
And the interesting thing, anecdotally, about the Nasdaq, so we monitor the individual components of the Nasdaq as a whole and on the individual. But it's interesting, the top 10 stocks in the Nasdaq, the Amazons, the Microsoft, the Apples, the top 10 stocks account for all of the growth in Nasdaq over 12 months. So the top 10 stocks have performed in 12 months, still up about 18%. If you take the bottom 90 of the Nasdaq 100, they're dead flat over 12 months. Yeah. So the growth is in those big names because money can go in there and get the liquidity. This market is as much about liquidity,
Absolutely,
as anything. So for people who want to look at the value, what value is trading at, what growth is trading at, I recommend a couple of great ETFs in the US market.
Yep.
The Vanguard Value ETF and the Vanguard Growth ETF. And if you look at that data, it'll tell you what you possibly already know, is that the Growth ETF has severely underperformed the Value ETF.
Correct.
The market's got nervous about these interest rate increases.
Correct. And Mike brings up a really good point there, and I've actually got that chart overlaid, those two ETFs overlaid. I look at it every couple of days. What am I looking for? I'm looking for whether growth's going to continue to sell off versus value. So that helps me sort of control what stocks I'll put in my portfolio at the moment. But also what I'm looking for is the turning point. So when is growth going to catch back up again? When does that mood change? Because, God, those growth stocks have been haven't they?
Oh,
some of them are looking pretty cheap.
Something terrible.
Yeah.
Absolutely.
Yeah, but I'm not ready to buy yet because I'm not, especially ahead of a Fed announcement tomorrow, right?
Yeah.
And, we'll see what they have to say. We know rates are going up, but what are they going to say about selling off their huge amount of bonds that they've purchased?
And that's what investing's all about, isn't it? It's like we are trying to say, well, look, here we are today. This is what's going to happen in the next 6 months. It's going to be a lot of fear out there. People will be trading their fear. And you could have a different opinion and say, well, look, maybe in 6 months this market can rally because the government's going to change their mind on interest rates. But you've got to trade today for what today is.
Yep.
You can't trade for 6 months because it might make you an orphan.
Yeah,
you can't afford it.
That's right, especially in this environment at the moment.
Yeah. So you think, Tim, and we occasionally talk about this, what's the likely scenario? And just give it a thought. Is it if they pull back on these interest rate increases, it's a low growth economy and high inflation, because the supply side inflation, I don't think, is going away. Natural gas prices are $7 in the US, they're $30 in Europe. Europe use 125% of the gas the US produces. So US is not a solution for Europe trying to get away from Russian gas. Just making a point. So I think we talk a few more anecdotes there, but the inflation's there.
Yep.
The low growth is there. Is it stagflation?
It has to go that way, right?
Yeah.
Especially lifting interest rates locally here, like overseas, even lifting interest rates and having all this inflation happening at the same time, affordability is going to go down and you're going to have stagflation. I think that's inevitable.
And so, like you always want to get a feeling for what it means to you, what it means to your friends and family, and to the investors we talk to. You just feel this burden coming on of low wage growth, higher mortgages, higher supermarket prices, and a government that what's the government's attitude toward this? The government that encourages property prices.
Well, when I think about the stock market and what I'm going to invest in next, I try and put myself into the shoes of the consumer, right?
Yep.
So what does this all mean for the consumer? Okay, so food prices are going up, energy prices are going up. I'm going to pay more on my loan. I'm going to have less discretionary spending money in my account, aren't I? Right? It means I'm not going to go buy that computer game. I'm not going to buy that new TV. I'm not going to buy that new car. I might go on a few less holidays. I'll stay at home a bit more. Go to the restaurants a little bit less.
But what will be safe possibly is utilities, because we still need gas, we still need electricity, we still need services, we still need childcare. The fundamentals like Coles and Woolworths. Well, we're not going to stop buying food, are we?
No.
And I think you said this morning that those share prices are reflecting that.
Yep. Ever since January kicked in, when the Fed came out and really started talking a bit more hawkish, those staples have been slowly climbing.
That's right.
That says a message, right? That says a message. A lot of people are worried that a recession is going to come on the back of this.
So that's how to be defensive. Healthcare, and we have a couple of small cap healthcare stocks we look after on the investor relations side. And healthcare, people spend the money on healthcare. The government will subsidise the healthcare. Yep. So those utilities that the government will make sure that we get our power, we get our water. It'll hopefully be a protected species.
Yep. So on the note of inflation, Philip Lowe and his team came up with a prediction that mid of 2024 is where the inflation rate will come back within their RBA range, 2 to 3%. So it sounds like we've got another year or so of inflation pain to come.
I'll be a bit more cynical on that and say that the Reserve Bank aren't very impressive on forecasts.
No.
But that's what he says, and we have to listen to it because that's what he's going to do.
Yes.
Right. And what we have to do is wait for the change in tone from both the Fed governor and Mr. Lowe as to what he's feeling at the time. Because let's face it, as New Zealand's gone to 1.5%, we've stayed at 0.1. Mm-hmm. What's Mr. Lowe's seen that the rest of the world hasn't seen?
Well, I think we've been the lucky country up until now where our CPI readings haven't been that high. It was 4.1, I think 4.5, something like that previously. Then we jumped up to 5.1. So what's next quarter going to bring, right? That's where the changing mood, I think.
Can't see the writing on the wall. The Aussie dollar goes from 75, 76 cents down to about 71 cents. Well, inflationary, I think. You've got to pay more for our imports. I've been trying to buy a car. I've been trying to buy a motorbike. There is no stock in Australia. If you want to buy a Honda motorbike, I was looking at a wait list, 3-4 months wait list. If I want to buy a car, it's a wait list. The Land Cruiser wait list is about 8-12 months. Yeah. It's shocking. Yeah, you can't get stock, and
And look, the scary thing out there at the moment, I feel that I don't think it's been talked about enough because the central banks have got the spotlight at the moment. But China lockdowns is a big factor to how long this inflation lasts and whether we can clear this supply chain problem or not. At the moment, the lockdowns are short and sharp for most of the manufacturing part of China, but that could change. And we need to really keep an eye on those factors, the factors in Ukraine. All of that's going to be the big thing we've got to watch for inflation.
You bring up the point that I like looking at trying to understand the macro. You try and understand as much as you can, and a lot of it's what not said as opposed to what's said sometimes. So Russia is committed to trying to keep NATO away from their border. Mm-hmm. So I don't see the de-escalation. China, I think what you're seeing though is deglobalisation. I think that's a theme.
Yep.
And we've talked about it in the office. So that means onshoring. And what does because if you've got your manufacturing overseas, you've outsourced that to Asia, China. If you've outsourced your manufacturing to China, that is now a strategic threat because of whether it's closed down because of COVID, whether China's cracked the poops with Australia not wanting to buy our iron ore. Indonesia, I think, has banned the export of palm oil, which is a key ingredient into fertilisers and urea, the fertiliser market. So everybody's becoming protectionist. Yeah. But there's an opportunity. Is if you're going onshore, and the governments have to onshore, that means the governments have to spend money on infrastructure and building things.
Yep.
We were talking last week, going through Doherty's Road out of West Footscray Way, through Tarnet. That used to be a wasteland of empty, barely call it farmland. That is now covered, one with track housing, the suburb of Tarnet, and it's also covered by massive warehouses. So what's massive warehouses about? And you go, well, what's happening is that there's a move to online buying, and we need storage. We start talking about onshoring, we need storage. So the theme of buying a REIT possibly that concentrates on commercial warehousing.
Absolutely.
And a warehousing that's close to central CBDs to give access to all people are trying to reduce their costs of holding it in expensive inner city locations. I think we walked past our old walk-in bottle shop the other day, Wigs in Queen Street, sign up, permanently closed, but you can order online. And I think that probably says a lot.
Yeah, there's a lot of big movement online. And I think you brought up a good point the other day, Mike, about in uncertain times, a lot of these companies actually want to hold more stock. And that puts more pressure on inflation, doesn't it, right?
And there was a cute way of saying that was manufacturing around the world since the mid-90s, globalisation has been just-in-time manufacturing, because you don't want to hold a lot of stock because that costs working capital, doesn't it?
Yeah.
So it's gone from just-in-time to just-in-case.
Just-in-case, yeah, I like that.
And if you're looking at a lot of the inventory, keep an eye on the inventory build-ups, because people have over-ordered just in case.
Yep.
And because nobody wants to run out of supply. But what happens with these interest rate increases, that even though you can see the inventory build-ups, which is good for the economy because inventory is building up, what happens if they can't sell it?
That's right.
So that's what we're keeping our eye open for, is just how the inventory, if the inventory builds up too much and they're not shifting in a economic downturn. Yep. And that point about the macro point, China, Russia, really the what's coming up is the US have confiscated $300 billion of Russian treasury savings, right? Now, nobody's going to condone Russia. What they're doing is inhumane and terrible. But the reality is that the US has unilaterally decided to confiscate the $300 billion from the Russians, and they've done it on numerous occasions with other countries they deem as unfriendly. So what you're reading about now is China's had a meeting during this week with some Asian leaders, and the issue is, well, if it's an option of the US at their sole discretion to confiscate, what is our strategic risk of our US Treasury holdings? Because we all understand, but to say it is, as the US has run this huge deficit since the end of the Clinton administration in the 90s, they've run a huge deficit to borrow money to buy the goods from Asia, and the Asians have in return taken US Treasuries. And Russia has taken US Treasuries as if the US dollars, US Treasuries are world saving. But now there's a risk of confiscation. Now, is that a risk for China? So the China, as you know, are looking at Taiwan with a glint in the eye. And if they were thinking of any advance towards Taiwan, other than the fact that Japan said we'd declare war, and the NATO would be right on, China has $1.2 trillion in US Treasuries. So, like it or not, that block of countries of China, Russia, India, and some of the other Asian Shanghai Pac economies are going to be sitting back going, listen, we need to develop alternative to the SWIFT payment system. We need to be able to deal in a currency, and what that looks like, we're not too sure. The European euro can't be a world reserve currency. I don't think the Chinese yuan is going to be the reserve currency, but they are probably thinking of a commodity-based style monetary unit to allow trade between those countries without the threat of the US intervention. And I think clearly the media is saying even now, I think the Pope was in the paper this morning, and he made a statement, NATO have been too aggressive in their approach to try and bring the border close to Russia. Now the Pope's saying that. He's saying it in a very diplomatic way.
Yep.
So if that's a reality, and then let's bring it back to our market, which is supply chain issues.
Yep, that's the big one.
Move away from globalisation to onshoring.
Yep.
For the US market, I think there's opportunity on onshoring because they're going to move aggressively towards that. There's nothing. One thing you can't take away from the Americans is their aggressiveness, and they will do something. Interestingly, they won't bring their hardcore labour-intensive manufacturing to the US, and the analysis is the South American countries will probably benefit from the US bringing their manufacturing closer to the South American countries. But the more their tertiary industries onshoring will be brought into the mainland, the more high-level value-add stuff. So their investment, long-term investment themes, I think we all should be mindful of.
Yeah, and that's one of the big things we're always on in the office here when we're talking amongst the desk is, what's the current theme and how are they likely to change in the very near future? And that's as an investor, if you're investing in the stock market here and in the US, you've got to be constantly asking that question, right? The current theme's quite obvious, value, right? Miners doing well on the back of a lot of countries wanting to invest in infrastructure and that sort of thing. But you want to be behind your value stocks while interest rates are going up.
And that decision, value over growth, is outperformed by 20%.
That's it.
And that's a good return.
Yeah, well, if the markets are averaging a 10% return, which they do in Australia for most, 20%, that's huge, isn't it? Right. So, for me, that's where it's at. Okay. Yes, we pick our stocks within those areas, and we have our scoring and have other ways of looking at which stock we want in that space. But high level, what's the current theme? And that theme's changing very quickly. From when I first started investing to now, I feel the themes are changing on almost a 6-monthly basis, right? We've had COVID, we've had all that sort of stuff play out. We've got the war in Ukraine, Russia. Previous to COVID, we had a deflationary problem, didn't we? We're trying to work out how we're going to get out of that deflationary problem. That was the theme back then. Interest rates are all-time low, so growth stocks went nuts. But now the theme's switched on its head. So.
And the other theme that has developed over the years, I think, is the concept of liquidity, because this market is very much about momentum. So you jump onto a momentum trade. Robin Hood can go to the up to the stars. No value, but it's got momentum, so you buy. Afterpay had momentum, so you buy. Rivian, the competitor to Tesla. I remember seeing it at $100, $110. Might have been higher. I think last night it's some $20 or $30. So once things lose momentum, and that's where the damage in the Nasdaq's been caused.
Correct.
Is in the Nasdaq tech stocks, obviously. When Apple, which is market capitalised $2.5 trillion. By the way, this is as big as Australia's market capitalisation.
Huge.
So when those numbers pull back, because they're facing factory closures in China, can't get stock. The technology stocks have been really beaten up. But just interesting to point out, though, the top 10 stocks, all household names for us, the Apples, Amazons, they're also in the top 10 of the S&P 500, by the way. So the liquidity is very important. And I think in this market, liquidity will have a very good value placed on it. So if you're going to get into a smaller cap stock, look at the turnover, look at the liquidity in that stock, because you might have picked up that nice IPO that you thought was a good idea, but try and put try and sell your stock to that bid, and the market runs away a lot, doesn't it? We see that time.
Yeah. You think there's a strong bid there, but then when you start hitting it, it just disappears.
Yeah. Tim and I are noticing that there's a lot of phishing going on, going on in the ASX. You think there's strong bids out there, and you got an ASX bid and you got a Chi-X bid, and then you go and sell at the bid, and the ASX bid gets hit and the Chi-X runs away before you get to them.
Yeah.
So we're getting very annoyed at the spoofing of the market.
Yeah, and that happens more in the smaller sort of cap
that happens
stocks
in the smaller caps.
Your larger.
And so therefore I bring up the point of liquidity and look for something that if you get in, that you have a reasonable chance of getting out without too much damage on that share price.
Yep. All right, so let's just really cap on the main points on this podcast. Interest rates are on the way up. It's the first rate rise since 2010. That's been a long time, guys, coming. Raises a lot of questions in the near term, doesn't it, right? So as an investor, as a trader right now, you've got to be watching the bond market for future rate expectations. You've got to be listening very closely to the communication from the FOMC meeting members and the RBA, right? We need to get, at all times, some form of a view of where rates are heading, and that's what the market's going to be reacting to. So rates are number one. Central bank meetings, be careful around those meetings, guys. That's where we're seeing most of the volatility. A week into those meetings is where we're seeing most of the volatility in the US markets. If the central banks act in the manner the bond market's indicating, that's just going to send the economies into recession. Money, we'll see some more sharp corrections out of the stock market, but money will generally flow to value stocks in this environment. So think staples, defensives, miners are still doing okay in this environment for the moment. That's the current theme, guys.
Yep.
That's where we're at.
And to me, just a big picture wrap. My benchmark, I look at the amount of outstanding Australian government debt. That debt has retraced back by about $50 billion in the last few months. So, and what's increased is the amount of borrowings for households, for homes, and business. So credit growth is on a tear at the moment before the interest rate increases, as of the figures produced at the end of March. And the government spending, because the borrowings are up, the government can spend less. So we've had a lot of stimulus. Those higher borrowing stimulus, the government's confident enough to pull back spending. We're all feeling good. This interest rate expectations will reverse all that.
Yes.
It will reverse the stimulus from the borrowing from the household and business, and it will force the Australian government to move further into deficit to support this what they call the stabilising mechanisms of social security. Yep. So and that's what we do here.
Yep, absolutely.
We look at the macro, we look at the micro, we look at individual stock scoring, we try and overlay all these themes and come up with a strategic point of view that hopefully you might find some benefit from.
Yep, absolutely. So guys, look, I'd love to hear some comments from you just below. Obviously, if you want us to talk about certain themes in the up and coming podcast, happy for suggestions, please put it in there. But please just don't forget to like and subscribe to our YouTube channel. Love your support. Thanks for listening in, and we'll catch you soon.
Catch you soon.
Bye for now.